Welcome back to OpenLine. Hope you're having a fantastic night. If you have questions, if you want to maybe seek out a financial advisor, here's a good way to start. John, tell us what the portfolio stress test is.
Sure. Portfolio stress test is, we are offering it today on this show to the first 10 callers. So if you're one of the first 10 callers, what we do is we will sit down with you, absolutely complimentary, and take you through our portfolio stress test, which is looking at all of your investments to determine a couple things. What will happen if the market turns again? How will it impact your portfolio? How much could you expect to lose? If 2008 happens again and the market goes down 38%, are you going to lose 38%? So we have some software and some technology that we can check the level of risk. We also look at the amount of fees that you're paying. So maybe you're paying too much in fees. We look at your investments through Morningstar. So we put them all in, and we, again, in essence, create a nice little snapshot, and we call the whole picture your portfolio stress test. So normally we charge a fee for it, but tonight we're giving the first 10 callers absolutely complimentary. So
no one's there answering the phone, but leave your name and number.
Leave your name and number. Yes.
Give you a call back.
Give us a call back. We'll call you back.
Easy enough. Okay, we promise we're getting technical now. We want to talk about different buckets and different options in those buckets to invest in, the good, the bad, the ugly. What can you do? Yeah.
All right. So our 4 buckets again. It's going to be a long night for me when I get home.
Your wife is sick of the bucket talk, but it makes sense to a lot of people.
It does.
Yeah.
It does. Because you really do. You have to categorize it.
Yes.
We can change them, but people understand buckets. So you need a cash bucket. So you need enough money in cash that you know you have access to. Some people say it should be, 6 months. It should be 3 months. It should be some type of number. Now, when you're looking at cash, there's only going to be a few options. And really, if you look at all of these buckets, there's only going to be a few options. It just depends on how the person you work with or how you want to use them. Cash is going to be just like it sounds. It's either going to be bank money, money markets, CDs, just something where you have access to it.
You get your hands on it, you're not going to get penalized.
Yes, you're not going to get penalized. You always, and you're not. It's not going to grow. Not very much. It's starting to come back. We're 1%, and so we're getting a little bit closer. But that's what it's designed to do. It's designed to have access to money. The second bucket is going to be your income bucket. And when we start out planning, and my suggestion for anybody who is nearing retirement, there are a couple of ways that you can plan for your income. If you talk to most advisors will say, if you have X number of dollars, plan on pulling off 4%. 4% may be a good rule of thumb, and it works for some people. I am probably more in favor of putting money into a separate bucket that is designed to guarantee your income. And we can use a couple different things. But before let me just share one more thing. Along those same lines, because if we use that adage, and let me just use $1 million. I can use 100,000, I can use $1 million, I can use whatever you want me to use. But if we have $1 million invested and we're pulling off 4%, we're going to pull out $40,000 a year plus our Social Security. Income will probably be somewhere around $80,000 a year. A lot of folks can make it on that.
Sure. Yeah, nicely.
Yeah, they'd be all right. Well, if you had $1 million in that balanced kind of strategy portfolio, again, after looking at your portfolio stress test, this may reveal something else, but if the market goes down 38%, if you have $1 million and you lose 40%, you are down $400,000.
It's a lot of money.
It is. And so now you have $600,000. And if you need to pull out 40%, $600,000, what is that, 7% now? So now you're pulling out 7% of your portfolio. And if that happens again the following year, your lifestyle's changing.
Yes. Because
you are not going to do it. Because stress-wise, you won't do it. You'll start looking for a job, you'll go back to work, you'll say, honey, we're eating cat food. You just won't do it.
Yeah.
So take a portion of your money and put it into an income bucket. So if we have this piece of pie, and sometimes it's tough to explain, and so if I draw pictures in the air, that's because I usually have a whiteboard. And you want to carve out a piece of your pie that will guarantee your income stream. Now, you can use a couple different things inside to guarantee your income stream. So some people use annuities, and we could talk specifically about that. Some people use bonds, and some people use dividend-paying stocks, all three of which will generate some kind of income. Level of risk is different with each one of them.
High to low, which one's highest, which one's lowest?
Highest risk is going to be the dividend-paying stocks. Lowest risk is going to be the annuity. People think bonds are safe because for
We've
the
always
last
heard that. Yeah.
and for the last 30 years they have been. But if you look at bonds for the last 30 years, they've actually been on decline. We're in a bear market with bonds. Because in the 80s, if you owned a home and you owned bonds, I'm going to tie them two together. Well, I'll tie three things together. In the early 80s, you could get 12% on a CD, and bonds were way up here. Well, the mortgage on your house was 18%.
Right. So
things ever since that, it's like 1978, have slowly come back down to where we are now. Interest rates are zero. They're 0.5%. So we're at the bottom, but people don't realize bonds are just an asset class. They're just one thing that you can invest in. You still can lose money in bonds. You cannot lose money in annuities. 100% guaranteed. Dividend-paying stocks are just that. So you're going to buy stock in a company, it's going to pay a dividend. Annuity is a big term. And now here's where we can get a little technical.
Okay.
We can have people turn the channel. Don't turn the channel.
Hang in
Stay
there with
me. Because you see them a lot. And sometimes you see them misused, but they can be a very, very good tool. Three kinds of annuities. You have fixed, you have indexed, and you have variable. A fixed index works, or pardon me, a fixed annuity works very much similar to a CD. They're going to pay a fixed guaranteed interest rate for X number of years. Doesn't change typically, goes up very, very slowly. Variables work just like mutual funds, and we'll talk about mutual funds in short term and long term. But the variable annuity ties money to a mutual fund or some type of stock or bond investment. And there's pros and cons to all of them. And I'll go back and we'll talk about that. The index, what it does is it blends the two. Index is very much a new world investment. They've been around 20 years, 18 years, very, very popular. Billions of dollars goes into these every year. And what happens is they're taking the best of both worlds. So they're taking this minimum guarantee and they're taking some kind of tie to an index and they're blending the two together. You can never ever lose money in index. You will never get 100% of what the market does. So you're minimizing your risk, you're taking some off the top, but you're also maintaining your floor.
Yes.
You can never go backwards. So you have safety and you have growth in one vehicle. It will not work the same as the stock market because you're not in the stock market, you're in the index. So it won't return the same. A lot of these vehicles, these annuities, have something called an income rider. So they'll guarantee your income X number of years out that will sustain. So if you need $40,000 a year, you want to take the least amount of money possible, set it aside for X number of years to guarantee your $40,000 a year. Depending upon your risk tolerance, you're going to buy or invest in one of these three different things. So it just depends on which ones.
Okay, I got it.
Which one's most important to you. Pros and cons to all of them. There is not one that is better than the other. It's just you have to understand the pros and cons of them both. Dividend-paying stocks, for example, are relatively inexpensive. They're going to lose money. Annuities typically don't have a fee, but you're giving up performance. You also have to be in them for a number of years. You also have a lot of folks who are selling annuities because sometimes the commission is high. And so everybody should put all your money into an annuity. Never. Never, ever, 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 ever put all your money into
one spot.
Yeah, or in one spot. You want to have different spots and allocate it out. So that's going to be the key. And I can't stress enough, understand the pros and cons of all of them. Here's where you don't have to understand them all. Like I'm not an electrician.
Right.
I learned that the other day.
I like that story.
Thought I had the power off, right?
Thought your hair was a little
See, a little poofy. Yeah, that was last week. I thought, oh, I can change I'll tell you, I put a dimmer switch in our dining room. And I thought, oh, the power's off for sure. I think I flipped the right breaker. Yeah, well, I put the... You know where it went.
That's why you go to an expert, John.
So when you're like this and your body's tingling and you have nothing in your hands, and you got shocked and your hair looks like this, you know what happened. Yeah, so you have to know the pros and cons and go to an expert. If it was more than a dimmer switch, I'm not touching it. No. Yeah, go to an expert. So.
All right, let's move on to the next bucket.
All right.
Are we ready for that?
Sure.
Okay.
Sure.
What's the next bucket?
We got to find something for short-term money. So something that you can look at that has a time horizon maybe of 3 to 5 years.
Okay.
And so now we look and we say, okay, we've got some money in cash. We know we've got our income guaranteed. How much money do I need to put in the short-term bucket that I can access at some future point? So what you're doing is you're creating a plan for when you're going to pull your money out. The longer you go, the more risk you can take. The shorter you can go, the less. Risk tolerance is different as well. But short-term buckets, short and long-term, sometimes we use, again, different vehicles. In the short-term bucket, you can use, we use different money managers. And what money managers are, how they're different than mutual funds, is you actually have your own money manager. It used to be that you couldn't get a money manager for less than 100, or if you didn't have more than $100,000, you can now get them $25,000. So it's come down. But these guys are the folks that manage municipalities' monies. They manage huge corporations' money. So you're getting the expert advice and the expert trading of institutional money managers. You could also look at something called real estate investment trust. So something that may have a little bit shorter time horizon, not quite the risk tolerance. You may have some bonds in there, but you could also blend in some mutual funds. And same goes true for long term. So now as we go long term, predominantly mutual funds, stocks. You could put your variable annuities in there and some other vehicles. So mutual funds, though, are you familiar with mutual funds?
You know, everyone throws it out, but I couldn't tell you the pros and cons of it.
All right, that's why
Tell me, John.
I wasn't sure if anybody was still thinking, or if we were thinking, oh my gosh, this is getting too boring. Mutual funds came out about 30, 40 years ago, and they came out to basically help people pool their money together. Now, they didn't do this. They do it collectively. We basically pool our money together. We give it to a fund manager. You know, years ago, a popular name was Peter Lynch, who managed the Fidelity Magellan Fund. Did it phenomenally. But we pool our money together, give it to a mutual fund manager, who then invests the money, and hopefully gives us some kind of return. What we're finding now as we go along, mutual funds still have very, very good pros. They're easy to get into, easy to get out of, very liquid. You can set your own time horizon, but you have very, very little control. So you can't do anything. You can't, for example, with a money manager, we could sell off in the portfolio. We can go in and say, okay, we want you to sell this for us and buy this stuff he's already purchasing, but we could sell off and do something called tax harvesting. Too complicated.
Yeah.
That's
terrible.
The 401 class, not the 101 class. But mutual funds are a good way to go. Some of the shortcomings we're starting to see, though, and let me just put it this way: if you have more than $250,000, you have outgrown retail mutual funds. So you want to be able to go wholesale. For example, when clients sit down with us, I mentioned we're fee-based only. You can buy a mutual fund from various different places, depending upon access. And let me put it this way: you could buy Windex, right? Okay. You can buy Windex at Publix, you can buy Windex at Walmart, or you can buy Windex at Sam's. Sure. You will pay a different price
at each one.
At each one.
Yeah.
If you buy retail, you're buying at Publix. Now, if you're getting retail service and it's good and you have a good experience, then keep doing it, but you're paying...
No, you're paying a lot
more than you need to. So we're Sam's. We're very, very much wholesale. We go direct because of the volume that we have. We can go direct and get a better fee. Some of your advisors can do the same thing. So when you're buying mutual funds, be aware of what the fees are, because a lot of people are paying upwards of 3.5% to own a mutual fund. Yeah, so it's very, very expensive. Okay, I'm going to take a time out right there. We're going to take a quick break. Gay, I know that you're on the phone. We're going to take your call next, so stay right where you are. More Open Line is coming up.